Bitcoin's breakdown is hiding a major shift. You can feel it everywhere right now. Timelines are full of fear, charts dripping red, and analysts calling for the end of the cycle again. Everyone feels like they know what's going on, and it feels very heavy, and for good reason, because something changed in this market. The patterns that worked before have stopped working. Old signals are breaking down. And that has a lot of people wondering if this is the start of something darker or the beginning of something no one's been ready for. And I stand in that latter camp because what's really happening behind this move isn't showing up on price charts yet. It's forming underneath, quietly, in places most traders don't even see. They're not part of those circles. I hate to put it that way. So over the next few minutes, I'm gonna walk you through what's shifting beneath the surface, what the data, the policy, and the money flows are quietly revealing if we can only connect the dots. So by the end of today's video, you'll understand why this breakdown feels different and why it might be setting up the most important phase of this entire cycle. All right, so let's get started with what everyone has been watching so closely. Bitcoin, as you would know, broke below the 50-week moving average for the first time since 2023. That line has acted as a long-term health gauge for price trends. When it holds, the cycle stays strong. However, when it breaks, traders assume the worst, as they have been doing. And to top things off, the 50-day average slid below the 200-day, forming a death cross that feeds every bearish algorithm out there. And all of this amidst the heavy ETF outflows and thin liquidity, making every move hit twice as hard. Because when liquidity thins, even small orders move the book. And we get a situation where the market starts trading on emotion and fear instead of depth. And we also see that the fear and greed index has dropped to 15, the same reading we saw near the February reset. So these are the moments when timelines feel heavy. Traders start exiting in waves, and conviction quietly moves from the weak hands to the strong hands, to those who really know what's going on, understand Bitcoin's fundamental value, programmable value. So that's what we see going on now. And we know markets speak through rhythm. When price breaks and sentiment collapses together, that rhythm usually signals exhaustion, not continuation. Yet the data only matters when you know what's happening beneath it. So, all right, here's where things start to get very interesting. While most traders have just been glued and staring at the red candles, devastated by them, sovereign players have been moving strategically and quietly. We know that the country of El Salvador, added 1,000 Bitcoin, about $100 million worth, its largest daily accumulation since adopting Bitcoin as a reserve. And that addition has lifted the countries to a total of 7,500 Bitcoin. That's how much they're holding now. And all of this happened while the price was sliding, while everyone was devastated, while global media was calling the top, and it still is calling the top. And inside the US, the first Bitcoin-backed municipal bond just went live. We see that New Hampshire approved a $100 million bond collateralized with Bitcoin, structured exactly like a traditional raise. Borrowers have to post 160% collateral, and repayment follows the same state rules. So it creates a situation where investors receive exposure to digital assets inside a compliant wrapper. So I hope you can see how these are not just speculative trades. They are structural integrations. They move Bitcoin from an optional asset to financial infrastructure. They are not blinking with this price. They're happy the price is cheap. And at the same time, US regulators have begun clearing a new path for banks. Of course they are. The OCC confirmed that banks may hold crypto on their balance sheets to cover network fees and settlement costs. And the Federal Reserve eased its supervision rules to let banks self-certify certain digital asset activities. So those two updates, they may sound technical, but they open the door for major institutions to operate directly on public blockchains. So while retail is focused on price, governments and banks are quietly building infrastructure. They aren't chasing trades, they're laying the very foundation of this next generation of financial infrastructure, of the future of finance itself. And that's the pattern. We keep seeing this cycle. The louder the fear gets on the surface, the quieter the build gets beneath it. So, all right, now that we see who's buying and who's building beneath the surface, let's look at the next layer of this story, the very market structure that's starting to form around them. So we see the CBOE global markets launched continuous Bitcoin and Ethereum futures, which are essentially contracts with 10-year life cycles and daily cash adjustments. They behave like perpetual futures, only regulated in the US. So for the first time, offshore style leverage lives on domestic rails. And the CME Group already runs spot quoted futures that traders can hold for up to 5 years. Together, these two exchanges now anchor more than 13 billion in open interest. This migration shows institutional traders want crypto exposure without leaving regulated environments. Predictions markets exploded too. We see that Polymarket and Kalshi hit 7.5 billion in monthly volume, up 400% year over year. These platforms let people trade outcomes 24 hours a day, and they run fully on crypto rails. This steady expansion means liquidity now spreads across ETFs, futures, prediction markets, and on-chain lending. Every new instrument tightens Bitcoin's integration into global capital markets. That's what market maturation looks like. So now let's shift gears and let's talk about what's happening on the forefront end of this system, the part regular people actually touch and interact with. DeFi is growing up. What started as code experiments and browser extensions, if you were here in previous cycles, is turning into real consumer banking now. Aave Labs, for instance, launched a consumer savings app offering yields up to 9% on stablecoin deposits, plus balance protections up to $1 million. Deposits connect directly through more than 12,000 banks and debit cards. And the app is live on iOS with Android and web coming next. And this is so important for mass adoption because their interface essentially removes the learning curve for new people, which we know is one of the hardest parts in getting into crypto. You simply have to open the app, deposit through your regular bank, and earn yield that outpaces money market funds. It feels like a normal savings account, yet every transaction runs on crypto infrastructure. And Uniswap is following a similar path. The protocol has already generated $1 billion in fees for 2025, growing 17% per month since Q2. Their new unification proposal activates protocol fee burns, which basically removes front-end fees and streamlines governance. Uni, their token, jumped 35% within hours of the announcement. Well deserved. And DeFi is now producing consistent cash flows, predictable economics, and consumer-ready design. This is the utility phase of crypto's growth curve. And frankly, a really good foretelling sign of what we can expect next year. And there's actually a really great visual from Variant Fund partner Alana Levin, which explains this perfectly. The crypto industry is growing through 3 compounding S-curves. First, that is creation. That's Bitcoin, Ethereum, stablecoins, and the foundational layers. Secondly, that is through accumulation. And accumulation was when we saw the big players enter into the playground with us via ETFs, sovereign nations, funds, banks, and this is the phase we've all been living in for the last few years. And now finally, we're entering into the utility phase. This is the phase where it all starts getting used. Payments, lending, staking, as we see through DeFi, real products people actually use. So everything that looked experimental 5 years ago is turning into real infrastructure. That's the rhythm of this space. Each wave builds on the last one. And the next one, the utility wave, is the one that connects everything that's been built so far. So, all right, let's circle back and bring this back to the asset that started it all. Because Bitcoin just hit a number that changes how every future cycle looks. Bitcoin just passed a milestone most investors never thought they would see so soon. Over 19.95 million Bitcoin have been mined. That's 95% of the total 21 million cap. Only about 1 million coins remain for the rest of history. And we know issuance slows each halving until the final fractions arrive around 2140. After the 2024 halving, annualized supply growth fell below 1%, meaning each future halving flattens the curve even more. Scarcity is now visible on a timeline investors can grasp. That predictability is why institutions treat Bitcoin as digital hard money. It's not based on promises, it's written into math. And every year that passes, supply pressure builds while demand channels keep expanding. And we see a new source of demand is preparing to enter the market, and it has nothing to do with traders. In August of 2025, the White House signed an executive order directing the Department of Labor to expand permissible 401ks investments to include digital assets. That single policy connects Bitcoin to $9.3 trillion in the retirement system. And Vanguard's data shows that only 5% of participants make any portfolio changes in a given year. And 95% simply keep contributing every pay cycle, meaning when Bitcoin enters target date funds, the default for most workers, it automatically becomes part of payroll flows. Even a 0.5% allocation could channel $79 billion into Bitcoin by 2032. These flows are consistent, unemotional, and continuous. They represent long-term conviction built straight into the system. So now let us connect all the dots. On the surface, we see price weakness. Underneath this, though, we see infrastructure upgrades, regulatory integrations, and new capital channels forming. Nothing has changed for the big players. And the ETF outflows that have spooked most people, the 99%, well, they're being absorbed by sovereign nations, institutions, and soon retirement vehicles. Liquidity cycles, remember, ebb and flow like the ocean, yet structural adoption only moves in one direction, and that is forward. The breakdown phase removes leverage, resets cost basis, and hands supply to holders who operate on multi-year horizons, as I always encourage us to do too. Every previous cycle wrote the same pattern. The difference this time is the scale of infrastructure being built while it happens. So as we wrap up today's video, remember every cycle produces a moment where fear outweighs logic. And this feels like that moment when the fear index hits 15 and sentiment turns quiet. History shows strong hands start accumulated, they're not scared. The rails of the next financial system are forming in real time right now. From AI innovation to tokenization, from state-backed bonds to retirement flows, the world is re-architecting around digital assets. Bitcoin's breakdown is hiding a major shift. The price action shows pressure. The structure shows progress. And when these two lines meet or converge, cycles restart. So stay ready, do not be caught off guard, and stay patient. And buy some more Bitcoin if you can, though this is not financial advice. Remember, the foundation for the future is being built right now. And when the market finally catches up, you'll already be standing where the next trend begins if you stay plugged in. So make sure to like today's video. Make sure you're subscribed if you're not already. Hit the notification bell so you don't miss my next video. We're dedicated to keeping you informed so you don't skip a beat. I love you guys so much, and I'll catch you guys here in my video tomorrow. Ciao.